Welcome to episode 2 in Options 101. Today we go after American style versus European style exercise. So this is pretty basic stuff for most of us, but we will get into the weeds of it here. So American and European options have similar characteristics, but their differences are important. Owners of an American option may exercise at any time before the option's expiration. European options, on the other hand, can only be exercised at expiration. Stock options are typically for a single stock. Index options are based on a basket of equities that can represent the equity market as a whole or a portion of the market, such as a specific industry or sector. A stock option can be exercised anytime before its expiration date because it's an American style option. An option on an index can typically only be exercised on its expiration date because it's generally a European style option. American style options typically include stocks and ETFs, while many market indices are generally European options. Trading deadlines and settlement prices are among the more significant differences between these options. Make sure you understand them before wading into one type of option or the other. American options are typically more expensive than European options due to their increased flexibility. You can exercise them anytime between the purchase time, the day you purchase them, and their expiration. So here's a bit of a table that breaks it all down, right? American options exercise anytime up to and including expiration date. European option only on expiration date. Flexibility. American options have high flexibility. You can react to early price swings and dividends. You can exercise whenever. European options, low flexibility. Holders must wait for expiration, though they can sell the option prior to expiration. Pricing. American options typically have a higher premium due to the added value of an early exercise. European options, in comparison, tend to have a lower premium due to the restricted exercise window, just on the final day of trading. American options are commonly used for individual stocks and ETFs. European options generally for index options, S&P 500, NASDAQ 100, and most OTC contracts tend to be European. So the seller's risk of an American option. There's a higher risk of early assignment, forcing the seller to fulfill their obligation prior to expiration. For a European option, the seller's risk is lower due to the fixed exercise date, which eliminates any chance of early assignment. So I always tell my students, if you're going to be selling options, make sure they're European. Right? That way you're not going to wake up and get assigned 100 or 200 or 1,000 shares of some stock, right? So stick to the indexes for that. Okay, so how is the exercise settlement value calculated for an American or stock or ETF options? The exercise price uses a closing settlement price on the date you choose to exercise. Very simple. Let's say the market closes today at 100. You're long some calls that expired a week from Friday. You tell your clearing firm or your brokerage house to exercise the option. It's based off today's settlement price, and then they look at the strike and they take the difference. That's how it works on the market. Now, for a European option that typically expire on the Friday morning of that expiration date, right on the open of the market, these options exercise this settlement value for AM settlement and XPX options is based on what's called a SOC, or a special opening quotation of the S&P 500 index. That is calculated on their expiration days, typically the third Friday of the expiration month, two ways. One, the SOC is based on the opening trade price in the primary market of each individual stock in the index on a given expiration day, Friday. Two, the exercise settlement amount for the XPX options is equal to the difference between the exercise settlement value and the exercise price of the option multiplied times 100. Because remember, in an index option, the SPX, they're cash settled. So take a difference between your strike, the SOC, multiply that times 100 times the amount of contracts you have, and that's your total profit or loss on that. Well, your profit. Your loss will be, if you're long, only what you paid for the premium if it closes below that exercise strike into the call. So that's the basics on American versus European exercise. Not that complicated, pretty simple stuff. Just remember, American options tend to be for single stocks and ETFs. So, a NASDAQ or a New York Stock Exchange or AMX listed stock, an ETF, things like that. European options tend to be either over-the-counter options with a broker-dealer investment bank or SPX and NASDAQ 100, those type of Russell 2000, those type of index options listed on the CBOE. So that's it for American versus European option exercise. Thank you for watching, and next time we'll introduce you to the first order Greeks, Delta, Theta, Vega, and Rho. And if you want to learn more about how to utilize this information, take a look at our website. The link is in the description where at the Delta House, we introduce you to basic options, advanced options, zero DT options, and how market dynamics within the marketplace, option dealers, CTAs, volatility control programs, risk parity, asset manager equitization, things like that alter the real world market dynamics. That's it for now. See you next time.